Welcome everyone to the Chamber of Commerce Business Week. This is one of the 4 sessions from Stephen Scone. So delighted to be able to welcome you all here. Just some housekeeping points at the outset. First is that this is being recorded, so if you don't want your face on the screen, you'll probably have to keep yourself invisible or put something over your webcam. Other than that, it's a 30-minute talk, and I'll tell you a bit about it. So, what we're talking about today is basically 4 types of succession options, and we're going to be talking about succession options in the current environment, how they're affected, how they compare to each other, and in the context of that, the 4 succession options that we're going to be looking at is a trade sale, an equity succession, management buyout, and an employee ownership trust, otherwise known as an employee buyout. So we're going to be talking through those. But what we're going to do, because it's not very long, really, 30 minutes to go through these things, we're going to compare several key themes that we tend to see when we get involved in these transactions. And those themes are timing, value, legacy, complexity, flexibility, and then last of all, because everyone wants to know how much it's going to cost me. So those are the things. So a bit about me. I'm pleased to see that quite a few of the people who are joining us will know me. And but my background is 20 odd years of corporate law, working with Stephen Scone, and during that time I've bought and sold many businesses in all sorts of different ways, and seen successful ones and some not so successful. I've seen the things that have stressed people out and the things that have kept them awake at night, and tried to address all those things one way or the other. So that's me. Actually, just one other thing I should mention. We are in a COVID-safe environment, in case you're wondering. And if anyone has any questions, please send them through on the chat. And we'll try and pick them up at the end of the session. But I just now let David, my colleague, introduce himself, tell us a bit about him. So David.
Christian, thank you. Yes, I'm David Gebby. I'm a relatively new partner at Stephen Scone. I joined in May during lockdown, which was interesting. And like Christian, I have just over 20 years worth of experience, particularly in the private mergers and acquisitions market, acting for buyers, investors, and latterly quite a lot of sellers, actually. I'd say that the majority of transactions I've been involved in the last 2 or 3 years have been for owner-managed businesses in the Southwest, quite often selling to trade buyers or to venture capital players. So I'm delighted to be here with Christian, and like Christian, look forward to exploring these themes around these 4 topics of trade sale, management buyouts, employee option, buyouts, and the equity, the full investor equity side.
Brilliant. Thank you, David. Okay, so we start with probably the number 1 type of exit for a founder, and that is the trade sale. It's by far the most common, the one that I've probably, well, both of us have spent more time on over the years, and that's the trade sale. The trade sale, in simple terms, is ultimately just selling the shares of a company to a buyer. So that could be another corporate entity or individual shareholders. There is a slightly different version of that, which can be an asset sale, where you're selling the assets of the company, but far and away on a succession type structure, we tend to think about a share sale. So looking at a share sale from a timing perspective, the thing about the timing is it's very rarely in the hands of the buyer, of the seller. The reason for that is you need a buyer to purchase, and they're not always out there. Sometimes there are, and it depends on what the market is like. But there is also another element to this, which is where the seller receives an unexpected offer, and that's the one that comes through by an email or an unsolicited letter. And that often happens where it's just hasn't been thought about because the owner is just spending all their time working on the business. If you choose to go out and find a buyer, then you need to engage agents or a corporate finance team who are going to go and look at your potential suitors who are going to potentially be interested. And the slightly unnerving aspect of that, or maybe more than unnerving, is that often your buyer is going to be someone who's potentially your competitor. So that's it's quite a key thing to think about there is, are you prepared to announce to the world, and particularly your competitors, that you're up for sale? So despite NDAs and everything else that can go into trying to address those things, you are going to have to advertise to those parties to a degree, and that information is hard to conceal once it's out in the open. So timing isn't really going to be in your gift. Looking at value, the reality is, I think it's the strongest of the potential sales. It's a well-trodden path, and with good corporate finance advice, and I know that some of our colleagues in the corporate finance world are on this webinar. They can very often find some enhanced value by way of identifying synergies, economies of scale that will fit the business, and therefore that would prompt a buyer to perhaps pay more for the business than they otherwise would. So that the value can be very much at the top of the tree in terms of a trade sale. That's why it's often the most suitable. That said, it can be offset by extensive price chipping. I mean, after all, the professionals, that includes me and David, when we act for buyers, we are looking to make sure that the business stacks up and that there aren't any horrible skeletons in closets. So that is that can lead to the price, that lovely figure that was offered at the outset being chipped away, leaving very little for you to sell. So there's still going to be something. Extensive warranties can also add to the sleepless nights. Warranties can last for anywhere between 18 months and 7 years in terms of the tax deed and warranties. Indemnities and earnouts can last just as long and can be quite something to worry about. And in terms of a share purchase agreement, the vast majority of the agreement is going to be made up of warranties, so these statements saying these are all true facts about the company, and if anyone turns out to be incorrect and causes the fact that the company to be worth less, well, that's grounds for seeking a reduction in price. So on the face of it, great for value, but it can be chipped. Legacy. It's rare to find that a legacy is going to be a big thing in a trade sale. A buyer is going to be thinking about how they can merge the two businesses and get the best out of them. The reality is 50% of mergers fail because of a culture clash. So if you're thinking that a trade sale is going to ensure that that your legacy, your values, and the way you run the business are going to be looked after for the future, then think again, really. Complexity, it is about as hard as it gets. Detailed due diligence, very lengthy questions, valuation requirements, earnouts, extensive warranties, as I've mentioned, potentially other consents that the buyer may need, change of control clauses in major contracts and so on. They can cause delays, they can cause headaches, and ultimately they can cause significant amount of negotiation at or before completion. There is also another element to that complexity. You are announcing that information to the buyer, to your prospective buyer. If they are a competitor, they've suddenly got potentially an awful lot of your detailed knowledge and database. So another thing to think about. Flexibility in terms of a trade sale, fairly unflexible, to be honest. They tend to be, it's an exit route for a buyer. You find a purchaser who's willing to take over your company, and they will almost certainly expect you, the owner, the founder, to be leaving on completion. I mean, the occasions where that doesn't happen is where there is a bit of an earn out or a need for continuity and handover. But by and large, most owners find themselves let out of the business within about a number of weeks, if not months, from completion. And then in terms of costs, the great problem with a trade sale is, in my experience, is that there tends to be, and it's always a minimum of 3 or 4 matters. Dozens and dozens of other issues have been settled by the time you get to completion. There'll be 3 things that are causing a problem. Never know what they're going to be, always turns up, and it can be the most unusual thing, but you can take as many days sorting out those 3 issues as the rest of the transaction combined. And if you're on a ticking clock in terms of costs, that can really escalate the costs and can make it quite painful. And it means that the parties perhaps have to think about, is it something they really want to stick, dig their heels in about. So that's a trade sale. And now over to David on a management buyout.
Thank you, Christian. So what do we mean by a management buyout? Well, I think all of us will have come across them, I suspect, looking at the people in the room. But generally, that's where the indigenous management team, the senior management team, acquire probably the control of the company from the owners, from the sellers. So that's what I would say an MBO is. And usually that management team will be supported by a mixture or one or other of debt from a bank, from a lender, or from equity investment from a venture capitalist or a private equity house. And they take over ownership of the company from the owners, the sellers. And so looking at our themes, which again, from our experience, our clients have kind of flagged to us are really important to them on a sale. So the first one of those was timing. So on timing, a management buyout, the seller, and remember we're looking at this from the seller's point of view, the seller does have some control of that timing in that he knows who the buyer is, he's identified the buyer, he's presumably talked to the management team over several months, if not potentially years, that they are the natural successors to take over that company. And so from a timing point of view, a seller will have the ability to plan, to put in place what is necessary to ensure that there can be a successful takeover and that seller can keep as much of the consideration as possible and can also perhaps plan it from a tax efficient point of view. And I'll come on and talk about that when we get to complexity. In terms of value, well, there's kind of 2 ways of looking at this. There's an argument that the management team know the potential, they know the upsides, they also know the risks, so therefore they should be able to afford to pay the full price. However, some of the management team would argue, well, we also know where all the risks are, and therefore we shouldn't have to pay the full price. But ultimately, a lot of the value will depend on how much money can be raised by the management team, what the view of the debt provider is, what the view of the equity investor is. And so therefore there will be a negotiation on that. But I suspect the price won't be as high as potentially a trade sale, because ultimately you're not getting those synergies, those cost savings, which a trade buyer might be able to bring about in terms of cutting head office, cutting some of the property costs by moving some of the assets around. All that's going to stay the same. So value is probably slightly less than on a trade sale, but it should still be a proper value. We then look at legacy. And again, from a seller's point of view, that can be mixed because that seller, he or she's run the business for all these years with the people, with the management team. Suddenly the management team take over and they change everything that seller brought about. And it could be quite difficult for a seller to feel that all the things they thought were important in terms of legacy are suddenly being changed by all the people who actually helped you put it in place in the first place. So from a legacy point of view, there's not going to be the wide-scale changes to the culture that you get on a trade sale, but there will be changes, and the seller has to accept that, and has to accept that those changes are being brought about by people who perhaps they didn't know that the management team had those plans or wanted to change things. So that can sometimes be a tricky one for a seller. We then look at complexity. Well, a management buyout, on the face of it, the sale and purchase side of it, whereby the management team, through probably a new company, will acquire the shares from the seller, should be relatively straightforward. After all, the management team know where all the skeletons are, they know where the problems are, they know, how good the contracts are, and therefore a seller can rightfully turn around and say, well, you know everything, you know as much as I do, so why am I giving you loads of warranties, indemnities, etc. However, as we all know, the providers of the debt and the equity investors in the new co as part of the MBO, they're going to want to be able to chase the money if their things go wrong. And obviously it's the seller who's received the money. So there will still be a level of warranties and indemnities asked for, although they should be less than you get on a trade sale. The other side of that, probably less affecting the seller, unless of course the seller stays in, is that there will be an investment agreement from investors, there'll be a shareholders agreement, which usually incorporates the rights attaching to the shares, or a shareholders agreement. There will also be the debt documents, and there'll be loads of financial DT carried out by the accountants appointed by the debt providers. So there will still be some complexity, less so for the seller, unless of course the seller is being asked to stay in. And it's not unusual, and really this is maybe a value point, that if there's maybe a sort of lack of funds, or the price that the seller is asking for isn't fundable, it may be that the seller agrees to leave some money in, or agrees to lend money back to the acquiring vehicle to allow the price to be maintained, but the seller takes some of that risk. In which case it's the seller who will have to maintain his or her rights in the investment agreement or in the loan note or whatever instruments used, which keeps the seller involved in the business. So there'll still be complexity, probably a bit less so for the seller than a trade sale, but there'll still be complexity for the managers with their investors and lenders, and that will have an impact on the seller. In terms of flexibility, well, we've talked about the fact that there'll be flexibility on timing, in that the seller will be able to control that. And also within the structure of the deal, as I've said, it may be that the seller can keep a share in the business. It may suit the seller to keep a share in the business. It may be from a tax point of view, it can be structured so that the sellers sell in tranches, or perhaps they retain some sort of preference share. It might allow them to enhance their ability to get entrepreneurs relief by keeping some ordinary shares and keeping above that 5% level. So again, there is flexibility. And again, in many ways, because it's between the management team and the seller, despite the influence of the lenders and the equity investors, there should be a relationship there which allows that structure to benefit and to be flexible to maximize the return that the seller can get. Finally, on costs, which was our last kind of theme, for the seller, its costs will be on the actual sale. They haven't probably had to retain a corporate finance advisor to advise on selling to a third party, because they know the management team are going to buy it. But for the management team, there will be costs, because the lenders will obviously want arrangement fees. The equity investors may want a annual management fee. There will probably be some sort of fees built in there, and some preference, a liquidation preference on sale. And ultimately, some of those costs will be reflected in the price. So the seller will probably take some of those costs, or it will be reflected in what the seller actually gets. But again, I think the cost will be less than on a trade sale. So that's the management buyout kind of way of selling. And I'll pass over to Christian to talk us through the employee ownership trust route.
Great, thank you, David. So what we've just talked about is the trade sale and management buyouts, probably the two most important exit routes in for a founder, for owners. Well trodden paths, and very well known in how the process work and the various different options. So with the last two that we're going to look at, we start to move into the more esoteric, interesting areas that are developing quite rapidly, and may be of interest to some owners more than others. So the one I'm going to talk about is employee ownership. And employee ownership, apart from the likes of John Lewis and Arab and a couple of others, didn't really exist within the business world until about 2014. And 2014 is a key moment in time because that's when the tax law changed to incentivize companies to become employee owned and to be able to utilize it as an exit strategy for founders. So what is it? What is an EOT transaction? Well, in very simple terms, you're selling the shares of the company to an employee ownership trust, and that's a trust that's specifically formed to acquire the shares for and on behalf of all of the employees of the company. And in many respects, it's quite similar to a management buyout. In terms of timing, it's probably unbeatable because you don't need to find a third party. You don't need to prime a management team to prepare to acquire the business. A founder owner can choose to engage and move down an employee ownership route at any time. And it's one of the almost unique features of it is that you choose your own exit, both in terms of when you start to implement it and also when you complete it. So some of the ones that I've done recently did one during the last lockdown, which completed in 3 months, but I've done others where it's run for 12 months and anything in between. But all of them started when the founder and owner was good and ready to start that. When we look at value, it's again, you would normally be expecting for a founder to be looking for full market value. Unlike a trade sale, you haven't got an arm's length purchaser in the terms of somebody out there who makes their own judgment call on the value of the business. So you are relying upon the professional advisors, professional valuers to determine what they believe to be the appropriate value for that company. Aligned with that is some tax clearances that they would also be doing as well. But in my experience, most of the companies that have gone into employee ownership, the founders sold at full market value. But the thing to bear in mind is that because there is no tax, no CGT payable if you're going into an employee ownership, and to do that, you just need to be getting over 50% of the shares into an EOT. There is a significant tax saving to be made, which can sweeten the transaction. So you are, instead of potentially paying 20% above $1 million, and most of the deals that we tend to get involved in tend to come with figures well above that threshold. So the tax savings can be run to hundreds of thousands, if not millions in themselves. That means that it is something that has to be considered at the very least, just because if you haven't thought about that tax opportunity, then you're missing a potential exit, which might suit you. The downside of it is that value is probably going to be paid over a longer term. So that means that although there will be an initial payment, and that's normally going to be out of excess cash in the company, so money that's not required for reinvestment, working capital, things like that, and might well reflect the money that the owners have left in the company because they didn't want to extract it and pay tax on it. But that can be utilized, it increases value at completion and can be utilized then to make an initial payment to the owners, the exiting owners, without any tax payable on it. So very, very good, albeit you're not getting the full price. The remainder is going to be paid over anything between 5 and 10 years, depending on how much is what the purchase price is and the profitability of the business. So tends to suit individuals who really understand their business, have real faith in the company, have real faith in their employees, because they believe that the company is going to still be around, still operating, still has the opportunity to grow over the foreseeable future. We look at legacy, and legacy is a is incredibly strong aspect of employee ownership, because these are companies very often where you have a founder who has really built this company up and believed in their values, and these are things that they would say, this is what's made us who we are. And there's a big opportunity to cement that within the structure, either through the articles of the company or through the EOT. And that's can be very important for some founders who want to know that the company is going to carry on the way that it was, looking after the people in a particular way, and growing, utilizing certain strategies and values. So very strong legacy opportunity there. In terms of complexity, well, you're in the territory of a management buyout, though we don't tend to have multiple lawyers involved and necessarily multiple financial advisors involved, because it tends to be a very aligned transaction. But there's still some complexity in it. You're still selling the shares. There's going to be a share purchase agreement. There's going to be the need to create an employee ownership trust, which complies with the tax rules. There's going to need to be a loan agreement, revised articles of the company, and things like that. So it's not too challenging, but there are definitely a few complexities, and understanding the new structure will be something that's important going forward. On the positive side, there tends to be less due diligence. We don't tend to do a thorough, a detailed due diligence. We need to know that the company stacks up the way that has been expressed, but we don't tend to be looking at very heavyweight due diligence. We're not also looking for extensive warranties. It's just really to give reassurance. And the quid pro quo for that is that if the EOT is acquiring the company over a period of years, then it's not the same as putting borrowed money from the bank on the line, where you might have personal liability. And that's another opportunity. There is generally no personal liability within an EO transaction. Flexibility, well, there's plenty of opportunity to retain shares within the company. So a seller might retain 25, 45% if they're thinking about its growth, not prepared to retire just yet. You can also incentivize management by offering EMI option schemes or an acquisition of shares on completion. So those things are not inconsistent with employee ownership and can be very helpful in incentivizing your leadership team. And then finally, in terms of costs, it's around the same sort of territory as a management buyout. If anything, it does provide for fixed costs, so you can be absolutely clear on how much this will cost, because you're not going into such an adversarial process. It tends to be a very positive process. So that means that it tends to be easier to identify exactly how much it's going to cost and when that's going to be payable. So that is an employee ownership buyout. And over to David for equity.
Okay, so what do we mean by equity? Well, I suppose it's not really a sale as such. It's a stepping stone to a sale, such that a business owner decides, that they'd like to grow the business a bit faster, possibly take some money out, but generally it involves attracting an equity investor to come in to put money into the company, to allow the company to then take up some kind of opportunity, or to grow exponentially much faster than it could have done just through normal trading or organically, to then allow it to be sold for a far greater price at some time in the future. I mean, the seller could possibly take some cash out, maybe to de-risk, or maybe get some of its that person's loans back. But generally speaking, an equity investor on a play like this does not want to give money to the seller. They want to put money into the company to expand it, to enhance it, and to make it more attractive, such that it will sell for a far greater price than the value that that equity provider puts in now. So I think that's what we mean by an equity investment. It's a stepping stone. So in terms of our first theme of timing, well, there's not a lot of flexibility because the business owner's got to go off and find that equity provider. They should use corporate finance professional to help them with that, if nothing else, to attract an investor, but also to argue that the value should be as high as possible. So timing is really difficult and probably will take, quite a few months, if not a year, in the planning. In terms of value, well, obviously the end game, the reason for doing this is so that the company can be sold at some future date at a far higher value than if the seller had not taken on that investment. Obviously, the seller's proportion, that ownership of the company will come, the percentage will come down, but you hope that lower percentage would be worth more than if they hadn't taken on that cash. So from value, you are probably going to get a higher value. Bear in mind that value is also going to be driven by the kind of greedy, or the kind of principles of greed driven by the equity or investor, who at the end of the day wants to buy in low and sell out high. So value should be good, but there are quite a lot of milestones to be achieved before you can get there. But I think the main reason for bringing on the equity investor is to enhance that value and to try and make that seller's share worth more than if they hadn't taken that on board. In terms of legacy, well, obviously the equity investor is going to be interested in the culture of the firm, otherwise they wouldn't invest. If that culture wasn't strong, they wouldn't invest. But the reality is that the equity investor is really going to take control, and they aren't going to be too fussed about the culture if it means that the value might go down. Or put another way, is they will change that culture if they think it will enhance the value. So legacy from a seller's point of view, I think, if you're prepared to take on that money, you've got to accept that there will be calls for change. And if things don't go according to plan, there will definitely be change. And that could mean that the seller loses their job, or other important people who are perhaps close to the seller will lose their job. So from a legacy point of view, it is questionable whether a seller can really hope to keep that culture. In terms of complexity, I think out of the 4 scenarios we've given you, it's probably the most complicated, because the equity investor may well have its own regulation which it has to abide by. So it could be a VC trust, it could be an EIS trust, and therefore they will have very strict rules as to how they can invest. You'll also then have quite complicated investment agreement and articles of association, which will seek to set out share rights, which the investor, of course, will be sure to make sure that it ranks, it has a priority. It may be that it's allowed to get its money back first before anybody else can participate in the proceeds of sale. But there will be various sort of techniques and structurings done, which will mean that the equity provider takes the least amount of risk. And therefore that's quite complex. And there will be a myriad of advisors, particularly if the company is also taking on debt at the same time. So I suspect the equity investment stepping stone to sale is probably the most complex. Similarly, on flexibility, the seller has really not shaken hands with the devil, but it has agreed that it will give up, the seller gives up the real control. So all the big decisions that need to be taken in terms of selling something, do anything outside the ordinary course, taking a lease, hiring somebody, firing someone, all that will need to be approved by the equity investor. So probably the equity investment is the least flexible from the seller's point of view. Also, it's probably going to be less flexibility in terms of how the sale is structured and how that can ensure that the seller gets the best tax breaks in terms of ER, etc., and the CGT liability. Because what will be driving it is the equity investors' return on investment. Because it's quite complicated, because there's quite a lot of parties involved, it's also true that probably the costs will be higher. And ultimately, those costs have to be borne by the company, by the company which is owned by the seller, from arrangement fees to management fees, and also sometimes fees on a sale. And the equity investor will probably use higher cost, more expensive advisors, because being institutional, they've got to be seen to appoint certain types of advisors. So I think, again, on that score, the equity investment will probably be the most expensive on costs. Okay, so I think, Christian, that's us. We have gone through our 4 options in terms of succession.
Well, thank you, David. So if anyone would like to raise a question, do feel free to put through on the chat line now, or if you want to unmute, raise the question. We're happy to hear from people rather than talking at you. So we'll give you a moment to think about that. Otherwise, we are hosting a number of other sessions. I don't think they're going to be quite as in demand as this one. So we're very grateful for your attendance at this meeting and for your participation. It doesn't look, I can't see any questions coming up. Is there anything else, David, that you'd like to add at this stage?
No, I mean, looking at who's in the chat room, I think quite a few of you will have a lot of experience of this. So it'd be very interesting to hear whether you get any examples or whether you agree or don't agree with what we've said.
So we've got one question coming up. So equity investments in general seems less popular in Cornwall. Is that mirrored in equity buyout transactions? Good, tricky sort of question there, because and hi Lloyd, good that you could join us. I think I think David and I have both been very keen on getting equity investment really moving forward in Cornwall, but it's always, I don't know if there's something in the air down here about founders wishing to grow and hold on to businesses. I know there's been a lot of talk over the years about people who run lifestyle businesses in Cornwall and slightly reticent about going for equity. I mean, it's, I'm very supportive. I think there should be, it should really grow. And I know there's been a lot of work put in. COSIF obviously been very important in that respect. And some of the angel groups, Chamber Innovation Investment Network has been really helpful in that. I think it's just a case of, keeping on and trying to keep that going alongside the likes of Crowdcube. You got any thoughts on that, David?
Yes, I mean, you'll notice that there aren't any so institutional venture capital funds really based in Cornwall. There's some in Bristol, there are 1 or 2 funds up there, but that would be a sign that it's probably they don't fish down here because maybe they don't think there is the size of companies for them to make big enough investments. Because ultimately the big institutional players want to make big investments, and therefore they need big companies to do that. However, I think in Cornwall there are probably quite a lot of high net worth individuals who either individually or with syndicates of other high net worths who are looking for deals, who are getting no money at the bank. They probably maxed out on ISAs and pensions, and therefore they are looking to potentially invest in some kind of equity play within comes in Cornwall. So that's probably the most active market for equity investment. There's not enough money. I mean, equity investment is great because it fuels growth. I mean, equity investment is there to take a company from A to B as quickly as possible and provide that funding. It's not always the best thing for the owner of that business because they can feel that the equity investor gets a huge return, bear in mind how much money they put in. But it is a good thing because it does fuel growth, and I'm sure we all agree that we need as much growth in Cornwall as possible. Growth means employing more people. It means more suppliers get paid. So it's got to be a good thing, and it's our duty to try and bring those equity players or encourage high net worths who live down here to actually, invest in local businesses.
Right. Yeah. Thank you, Lloyd. I hope that sort of hope was helpful. You've probably seen just as many challenges as we have. Do you have any thoughts on that?
Yeah, no, that was interesting points that you've made there, which I've certainly seen and heard similar things said, and I'm really intrigued by this sort of slight aversion we seem to have in Cornwall to equity investment, and that sort of I need to hold on to the whole cake sort of approach to business. But I suppose my question also was curious about when you're looking at these options and advising clients. Do you find that aversion to the equity route exists when it comes to succession planning, or does that open people's minds up a little bit?
Good question. I mean, what I tend to see in the in sort of equity investment tends to be more towards the early stage, where it tends to be thought about as potential high growth with an exit in a few years. I think there is something about a lot of owners who set up something and they have a dream that they want to see it grow and see it right through to the end of its journey, and that may run counter to this idea of a 5 to 10 year strategy to then potentially sell and walk away. I think that's a cultural thing that's an issue, possibly around when we're outside of the of more the sort of urban areas. But I don't know, David.
Well, I think in Cornwall, a lot of the businesses here are people who want to live here, who are settled here, who maybe have got long-term roots here, and there could be a perception that if you sell to a private equity house, that somehow they're going to just slash burn, drive the business incredibly hard, and then sell to a trade buyer who then move it up country, and Cornwall will lose the business. So I think there is I noticed from clients there was a feeling of that. There's a genuine loyalty to the area. And owner managers aren't sort of financial engineers who are looking to buy and sell every 5 years. They're looking to really make something that's lasting and, as I say, put those roots down. So it could be that feeling, that kind of attachment to Cornwall means that they're just at the back of their minds not 100% comfortable about possibly getting in these financial guys who are not from the area, and then they'll make a lot of money, but then everything goes. So maybe that's part of that cultural reluctance to that, and also people will stay in the area. They're not going to move away, whereas people in the southeast perhaps move a lot more and don't kind of feel so attached. Maybe they'd feel difficult going down the pub and saying, well, I made millions, but all my staff got shafted. So I don't know. I mean, maybe that's part of it.
Maybe something. Thank you, Lloyd. I'm conscious of our time. We're sort of coming up to the end of that. There is another question that I just want to pick up, and it's a question about care home deals. I think it's fair to say our healthcare team have been unbelievably busy it's the activity in that particular sector seems to be very, very strong. I'm not sure what has. I mean, obviously there is, there's clearly a lot of issues going on within the healthcare aspects of caused by the pandemic, but there is a very strong appetite, it seems, and it may be that we're seeing a degree of consolidation in the market. So I think it is a lot of opportunity going on in that area. So it feels quite strong. Okay, I think that brings us to the conclusion for this. If anyone would like to raise anything with us separately, privately, discreetly, whatever, hopefully we've shown that we're quite friendly and engaging and know a few things. So look, please do get in contact with us. We'll also be looking to share. We have made some notes that we've talked through to give this comparison. Comparison of the different exits and their pros and cons. So we'll send that out in the next couple of days, but please don't hesitate to contact us. So other than say goodbye from me.
That's goodbye from me.
And we'll look forward to seeing you at 2 in the morning for David and mine presidential US debate special. Not really. Thanks everyone. Bye-bye.
Thanks everybody. Bye-bye now.